A very warm welcome to you to this rather longer presentation from Harvard House. This presentation is entitled Keeping Your Head When Others Are Losing Theirs. And we know our portfolios have been more volatile, but I hope to demonstrate it's for the right reasons. So I'm going to look at some key aspects, which is why this presentation will be a bit longer. So what makes us different? We think there are three key figures or factors that come into the Harvard House investment philosophy that separate us from the herd. And these three factors we're going to prove independently, but it's really together, and we'll demonstrate how they work together. It's working together that they really provide the benefit for the client in the longer term. So going on to the first one, when it comes to investing for the long term, equities and property are almost always best. And that's despite the short-term volatility and even potential loss. After asset class, cost is probably the next most significant component to investment success. Not fund manager performance, since really over time, the gross return among managers converges such that only cost really differentiates us. The third thing, and this is particularly pertinent for retired investors, but no less for those who are working towards retirement, living on dividend income results in sustainable inflation-beating income. It also means that the investor is not dependent on capital growth and can take a much more sanguine view about capital volatility. So let's look at the first principle, asset class. If you've been associated with Harvard House for any length of time, you'll know that we advise that there are only 4 asset classes available to the retail investor: cash, bonds, property, and equity. Pretty much any investment you bring to me, while there's a litany of them, I will be able to demonstrate that we can distill it to one of these 4, or a mix of these 4, or a derivative of these 4. And they each work in their own way, no matter what the investment may be called. The underlying instrument works pretty much the same way. So if I look, and this slide is entitled Stock Markets Are Scary. So what we've done here is we've charted 3-year periods in the period 1960 to 2018, and it is a rolling 3-year period. So every data point on this slide represents the last 3 years compound return in the asset class that is reflected. So breaking them down, you'll see that the dotted yellow line is inflation, which you can see has risen in the late 80s, early 90s, and then fallen back down again. Bonds, the light blue, you can see that bonds are also volatile. They have periods of negative return, periods of positive return, and 3 years can be fairly wide in terms of the kind of return that it gives. The dark blue line is cash, and there we can see the evidence that we all know, that cash is the least volatile of the asset classes, always above zero in absolute terms, and you can see that the cash rates were very high in the late 80s, early 90s, when inflation was particularly high. And then the green chart, or the green line, each data point represents the 3-year return in the JSE All-Share Index over the time period. And you can see it would be great to be back in the 3-year period ending 1979, when it was a 30% return. And certainly on the downside, we can see there have been a number of years over the past 58 where markets were down. And certainly the last 3 years, which is pretty much how it feels, have been among the worst over that time period. So let's just move the time frame out a little bit. All we've done here is, instead of looking at 3-year periods, we've looked at 10-year periods. So every data point along here represents the return over the previous 10 years in that asset class. The graph charts are the same color, so Yellow is inflation, light blue is the bond market, dark blue is cash. We have a new entrant there, which is red, which is property, and that is listed property. But please bear in mind that listed property has a fairly short history in South Africa, so it won't show materially in this presentation. The green is the equity market, and the thing to notice is that in every 10-year period going back over the last 58, equities have been the outperforming asset class, no matter whether we've had rising inflation or declining inflation. Only one period, and that's the data point ending 2004, where equities came close to a 10-year return on cash, but still remained above, and that consistently proves that equities is the place to be. Interesting point to note is in rising inflation environments, so that's the period 1960 through to the mid-90s, cash and bonds lose money, whereas equities can make money in a rising inflation environment. It's a very important point to note. So let's stretch again further and look at a 20-year rolling return. So again, each data point here represents the previous 20 years of investment in each asset class. We've got the same major four, inflation being yellow, light blue being bonds, dark blue being cash, and the green being equities. And here we can see that over a 20-year period, equities really start to come into their own and significantly outperform the other asset classes. And so the point that we try to make investors understand and take as critical in their own investment planning is, yes, equities can be very volatile and uncomfortable in the short space, but in the long term, they are the only place to be and will certainly make up for the disappointments in the short term. Right, so let's look at that as an example from a numerical point of view to make it easier. What we've done here is we have looked at an investor who has R1 million at the end of December 18. What would he have had at the end of December 20 years previously if it had just been inflation, if he'd received an inflation return over that time? Well, we can see inflation was 5.51% per annum, and his R1 million would have been 333,000 Rand back in December 98. Let's look at if he had done various other things with that money, what would it have been worth? Well, he could have put it into rolling 1-year fixed deposits, and every year he compounded the interest back in, and that would have turned his 333,000 into quite a mouth-watering 1.67 million Rand, which looks quite appreciable, but that does assume he's reinvested the income. Had he put his money into the bond market, he would have almost doubled what he got in cash and taken his 333,000 to 3.157 million. But if he had gone into the equity market over that time period, he would have received 9.18 million Rand from his 333,000 Rand. And it just shows the difference between equity and the other two asset classes. This is the place you want to be over the long term. Moving on to the second principle, which is costs. If we look at the chart, which just basically replicates the 20-year returns of equities, bonds and cash, but what we've done here is we've charted it less inflation. So these numbers are what we would call the real return. In other words, the gross return minus the inflation over that 20-year period. Where it's above zero, you get real wealth growth. Where it's below zero, you get wealth loss. And you can see that there are periods of wealth loss for bonds and cash, but no wealth loss for equities over 20-year periods. So let's just assume if the real wealth growth is, for example, 5% better than inflation on an investment, then every 1% of costs I add on, it is a small number in itself, but it represents a decline of 20% of the real wealth growth. And that's really what everyone is looking to generate. So if we take that one step further, if a client is invested, say, with Harvard House, and he's exposed to equities, he's in a very low-cost environment, but he decides he doesn't like the volatility, transfers to an advisor on a platform who suggests for his risk he should be in a balanced fund, and he, as a result, increases his costs to 3% per annum, then his real return could be decreased by as much as 40% over the 20 years compared to the equity fund at 1% per annum. And that is appreciable wealth lost. So let's have a look at that from a graphic perspective. The dark green line is the rolling 20-year returns on the all-share index. The light green line does nothing more than assume that you paid 1% per annum for that fund to be run. So that's why it tracks it so closely. The dark blue line then says, this is an investor who says, I cannot take the volatility of the markets. I'm going to listen to the advisor who says I should be in a balanced fund. And so it's 20-year returns on a 60% mixture of equity, 30% mixture of bonds, and 10% mixture of cash over each 20-year period. And you can see that drops the line down a little bit further. And then the light blue line says, and in addition to choosing the balanced fund, I'm now paying 3% to be in that space. And that's the light blue line. And you can see the massive difference between the light green and the light blue in terms of investment return over 20 years. Let's bring it down to numbers to make it a little bit easier. So we're still looking at 20-year return compartments here. And all we've done now a little bit differently is we've assumed at the start of every one of these 20-year periods, we invested the equivalent, inflation-adjusted equivalent of 500,000 Rand. And then we've brought it back to what it would be worth in today's money after the 20 years of investment. Now you can see certainly there are some years that are the better 20 years in the stock market and other years that are not so good. So we have a range from roughly 5.7 million for the best 20-year period and just under 2 million Rand for the worst 20-year period in the market. But on average, your 500,000 will grow to a real value of 3.4 million over a 20-year period in the market, paying 1% in costs. As an alternative, if I look at the blue line, that says I'm in a balanced fund over 20 years with a 3% cost. And you can see there, the average return I get is just short of doubling my money. Yet, even if I look at the absolute best year in a balanced fund, it doesn't come back even close to the worst year in an equity fund. And this is just a demonstration that both asset class and costs together are massive for an investor's long-term outcome. Now, the third point that we think is pretty critical, and it's a mantra of Harvard House, is separate your income from capital. So if I have a look at it here, this chart charts on an annual basis, so it's for the calendar year, the change in the all-share index on a year-by-year basis from 1963 to 2018. You can see there are 16 calendar years where the stock market declined, some of them well over 20%, and it really speaks to the potential for volatility in the stock market over a time period. However, if I go to the next graph, this reflects in the same calendar years, over the same period, what the change in the dividend was over the prior year. And so when it's negative, it means the dividend went down. Not that there was no dividend paid, just that the dividend went down. And the closest or the worst we've ever got is just short of a 40% decline. But you can see that in spite of a 16 times decline in the share market over that 58 year, there are only 4 periods where dividends declined over the year before. And in many cases, they didn't even reach double digits. And that is what we say is income is far more stable than capital. And so if you're living off dividend, you have greater peace of mind than someone who's living off a capital change. So let's illustrate this again with numbers and an example. This takes an investment of 10,000 Rand in 1960 in a fixed deposit and rolling it every year. In year 10, the client has built up an investment of just over 16,000, but from year 10 onwards, he takes his interest as an income. So we can see there on the left-hand side, in the first year, he gets just over 1,000 Rand into his bank account, and as interest rates climb into the late 80s, early 90s, it gets as high as almost 3,000. And then when interest rates come back down towards now, we see we're moving back to the 1,000 Rand mark. So here we see fixed deposits never really growing your asset value appreciably, and the income certainly not keeping pace with inflation. By comparison, this investor took the same 10,000 Rand and put it in the equity market, and that is reflected by the green line, and the red bars reflect his dividend, his annual dividend payment over the time frame. So you can see by the time he's got to this point, his market value is well north of 6 million Rand, and his dividend per year is reaching towards the 90,000 Rand per year mark, in spite of the fact that he suffered volatility and experienced risk. Here's a comparison which just really looks at that same 10,000 Rand, the equity income being the green charts, that's the dividends paid over the years, and the blue bar is the 10,000 Rand compounded for the first 10 years and then the income drawn thereafter. So you can see in the early years, certainly income far better from a fixed deposit, but as time goes by, there's just absolutely no comparison. So in summary then, coming back, there are 3 key factors in making your long-term portfolio work for you. And this is how the Harvard House investment philosophy is built. 1, invest in equities and properties for the long term. Ignore the short-term volatility and loss. 2, minimize costs, since over time, gross return among equity managers converge such that only cost differentiates. And ensure, 3, that you live on dividend income to provide sustainable inflation-beating income that allows you to weather the market volatility. That brings me to the end of our presentation. Thank you very much for your time. Please hop onto our website, www.hhgroup.co.za, for more material and more of our videos. Thank you very much.